Everyone, welcome to this latest edition of Markets Monthly, Strategies and Perspectives. As always, my name is Gary Quinzel. I'm the VP of Portfolio Consulting here at Wealth Enhancement. And I'm joined by Yoshioka, our Portfolio Consulting Director, and one of our senior investment strategists. And today we're going to go ahead and dive in, talk a little bit about some perspectives and insights from the roundtable. I'll hopefully give you some insights about what's happening in the markets lately. And it's hard to believe that we are almost at the end of the third quarter. The fourth quarter is almost upon us. And here we are, the market is reaching consistently new all-time highs despite this wall of worries. We've been through so much this year. It's amazing to believe that we've had inflation, we've had slowing jobs data, we've had tariffs, and regardless, all of that, it hasn't mattered. The market has just been climbing higher on the tailwinds of artificial intelligence, growth stocks. We've seen a resurgence in international stocks, all of which has continued through the third quarter. It's been yet another strong month here in September. I know a lot of the data we're going to share with you is through month end as of the end of August, but really the narrative hasn't changed that much. We've seen continued strength out of corporate earnings, a relatively strong earnings season. We've seen the consumer continue to spend. We've seen overall resiliency, whether you're looking at macroeconomic data or the markets itself. It's really telling the same story. However, we as investors should remain cognizant and cautious about some of the risks that are looming. And I know we'll dig into that when we talk about some of the macroeconomic data and some market observations. Markets are concentrated. We have to be cognizant of that. And yet we have had the one thing that we've been waiting for many, many months, almost a year, I should say, is that we finally got that rate cut. And so we are now starting, it's definitely a pivot or a catalyst, I should say, in monetary policy, which should lead to, the markets forecasting or expecting even more rate cuts. So the markets have certainly welcomed that in the short run. So a lot is happening, a lot of changes are in flux. And before we go ahead and dive too far in on some of the economic stats, I want to hand it over to Aya. She's going to talk a little bit more about the markets and some of the observations as of late. Aya, take it away.
Appreciate it, Gary. So I love this slide that kind of goes through all the different asset classes, and I know this is through August. I think when we entered September, people were really fearful because September is seasonally a really tough month, but that really hasn't played out so far. So we've seen on the equity side, through August, we were seeing really strong returns, especially internationally. That continued from a year-to-date basis, but you've seen the U.S. equity market really kind of come back recently, right? Quarter to date, you're seeing the S&P 500 and small caps really have strong returns so far relative to the international side, which did really, really well to start 2025. And we like to look at these long-term numbers, right? So that's why you have the year-to-date numbers out there. And then when you look at so far in September, emerging markets have continued to do well. Small caps have continued to do well. And so, there's really a sense of risk on, at least on the equity market. On the fixed income side, again, we're seeing pretty good returns across the board. So on a year-to-date basis, mid to high single digits there, it's pretty good, I think, from the fixed income side. And despite rates coming down, you're still clipping a pretty good coupon on the fixed income side. And then when you put it all together in a 60-40 portfolio from a global perspective, you're getting pretty solid returns, double-digit returns on a 60-40 portfolio, especially if you include those international or emerging market assets on the equity side. And commodities have done okay. It's actually gold that's really driven a good portion of the commodity return, because oil, which is the other sort of large asset class in commodities, really hasn't moved a whole lot, which is why I think inflation has been a little bit more subdued. And I know we're going to go into some of that as we go through some of the economic data. But if you go to the next slide, I think one of the things that we keep hearing from clients is, how different this is, at least from my perspective of, the tech bubble in 2000. On one hand, we have concentration that is now sort of surpassed that dot-com bubble level, and you can see that from the chart on the left-hand side. But on the flip side, when you look at earnings the Magnificent Seven have really just exploded from an earnings perspective. So there's actually, numbers that are supporting the price growth of these stocks. And that wasn't the case back in 1999 and 2000. A lot of these companies were trading at valuations or PE multiples that were, 100 times, a lot larger, and those earnings weren't as solid. They weren't backed by as much free cash flow as we are seeing in the Mag 7. It is, though, something that we continue to monitor, and it's never great to see this kind of concentration in markets, but it is slightly different than what we saw back in the 2000 bubble. If you go to the next slide, on the fixed income side of the world, we like to look at the Treasury curve, and this is through at least the first week of September when we ran this, and you've seen this downshift in the Treasury yield curve, and it is slightly steeper than where it was at the beginning of the year, and that really is because it's reflecting that expectation going into that Fed meeting that happened, just last week, where the Fed finally cut interest rates, and it impacts that front end of the curve. So you're seeing that bigger move in the front end than you are on the long end of the curve, because the long end is a lot more, is dictated a little bit more by GDP growth and the outlook that, the fixed income investors have for, the overall US Treasury market and the debt situation that we have here in the United States. And with that, I will turn it back to you, Gary.
Thanks, Aya. Really interesting observations. Everything from, the fact that the global 60-40 year-to-date is at 11.7%. You compare that to 2022 when stocks and bonds both went down at the same time. We are in such a different environment despite all these different concerns. And the other thing that really stood out that you talked about was the difference between, the different concentration periods and today. When you think of the fact that going back to 2000, the earnings have grown sevenfold relative to the rest of the S&P 500, that's, it really demonstrates why investors come to the US for growth, right? US is the growth engine. The index is constituted by tech stocks, and that's really one of the reasons that we've seen such continued strong growth here in US equity markets. But focusing a little more on what the Fed is going to do, I'm glad you ended by showing the yield curve. This is really driven by what Fed Chief Powell has talked about, and the most recent rate move down that we saw the first 25 basis point cut in a year. It's driven by two things. Ultimately, it's driven by inflation, and it's driven by the labor market. And so this chart here should look really familiar at this point, because we've been talking about it for the past 3 years. We've seen what we're looking at here is the difference between core inflation measures, whether you're looking at the CPI index, the PCE index, which is what the Fed cares most about, or the PPI index, which is the producer's price or the wholesale price index, and it's much more volatile. Regardless, they're all directionally moving the same pace, but we're seeing more extreme movement in some of those than others, especially PPI, because that is going to more directly impact what might happen because of inflation. And there's been some noise there. We looked at the July data. It was a huge uptick, one of the largest upticks we've seen in quite some time, and then PPI actually decreased month over month in August. And so regardless of which measure you're looking at, it continues to be higher than the Fed would like it. And it continues to hover north of around 3%, which is really problematic, not in the grand scheme of things. But if you think about what the Fed is trying to do, or what they're being potentially pressured to do, is cut interest rates because just to boost the economy, because the labor market is slowing, but we still have the situation where prices are more expensive than we'd like, especially certain things that are household items, things like milk and eggs. A lot of people are still talking about elevated prices at the grocery store, or it's just everyday things that kind of get lumped up into what they call a sticky basket. And that the Atlanta Fed has a sticky basket index that is still up 3.4% year over year. And so this has not gone away yet, and we still do not know the long-term impact of what tariffs are going to continue to be implemented, how much is going to get absorbed by companies, and how much is going to get passed along. So we are definitely still in the very, very early stages, and this is what's making the Fed's job so challenging, and will be challenging for the next couple of meetings. So we are very much highly expecting another rate cut at each of the next 2 meetings in October and December. But the fact that you see these lines here, not only above that 2% trend line, but actually slightly ticking higher, that is a little more, concerning. And if we jump to the next slide, we'll focus on the other side of what the Fed is really more focused on. And Chief Powell actually talked about this in his most recent communication, is that the risks to the labor market are certainly to the downside right now. And that's because we have seen lower payroll growth, and a lot of the headlines have been around these negative revisions, these downgrades. And then we're seeing on the left-hand side, these are the annual revisions. And we've really seen this kind of structural trend to the negative side for quite some time. And so we do have to take some of this data with a grain of salt. But one observation we've made is that when companies start reporting a little later, and that's usually the reason for some of these negative revisions, it's because they have a lot of other things that they're kind of dealing with at the time. And so it has historically meant that we're starting to see some growth, so a decline in growth in the overall market, and nothing to be overly alarmed about, but it is kind of one of those kind of warning signs that we're starting to pay a little more attention to, and that's exactly what the Fed is talking about, and that's the reason why we saw that rate cut. And so you kind of have to be careful what you wish for in one of those situations. We're seeing that kind of bullish steepening of the yield curve right now, and that's what Aya showed, and that negative downward pressure on short-term rates in the short run. But you don't really want to see that bearish deepening where you start seeing the rates go higher on the long end. That's something we're going to have to watch really closely. And a lot of it's going to depend on what happens with growth, right? It's okay to have what we're experiencing right now, moderate growth, but if we see this kind of spiral and we see labor will kind of get out of control, that's where we're going to be in a situation that could be negative for markets in general. If we jump one more slide, the last thing I'll highlight, the pulse of the economy is really about the consumer. Historically, roughly 70% of our GDP, our gross domestic product, is driven by consumer spending. And at the end of the day, those that are fortunate enough to have income and have wealth have continued to really push the economy. And so on the right-hand side, you see this is one of many real-time indicators. We call them the boots on the ground, things that just kind of take the pulse of the economy, whether you're looking at restaurant bookings or TSA, people passing through TSA, or people going to Broadway plays. There's dozens of different ways you can look at, see how are people acting in real time, in real life, and they all tell us effectively the same story right now. There's a lot of activity right now in the economy. People are still spending. People relatively are still good from a credit standpoint. If we look on the left-hand side, delinquencies have slightly ticked up, but we're nowhere near some of the more problematic levels that we've experienced historically. And so we do feel good overall, and we look at lots and lots of other data. For sake of time, we're not going to share everything today, but between the hard data that measures things like productivity and GDP, and things like soft data that are surveys that just take the question, how your sentiment is or how you're feeling, it's still a very mixed bag. Consumer confidence is lower than we were pre-pandemic, but if you look at the expectations, how people are feeling about where they're going to be 6 months from now, overall, it has been ticking a little bit lower, and so we have to just be aware of that. But overall, the pulse of the economy remains healthy, and that's why we think that overall, compared to where we were, say, 6 months ago, when everyone there was heightened uncertainty around tariffs and policy, I think we're in a much better place now, and the odds of an economic contraction seem much less. So with that, I'm going to go ahead and pass it back to Aya to talk about some roundtable perspectives.
I appreciate it, Gary. So I think you made some great points too, in terms of, clients are feeling a little uneasy, right? They're seeing the slowdown in the economy. They might be feeling it. They're still dealing with high inflation, and they're confused in terms of when they look at the markets and new all-time highs. I think we're at 28 new all-time highs in the S&P 500 for 2025. And the Fed's cutting rates, and so there's a lot of confusion, I think, that's going on when it comes to markets. And I think the Fed is really in a tough place, right? They're choosing to support the labor market in order to support the consumer and make sure that despite some of the elevated sticky inflation that we're seeing, that they're able to sort of get refinancing. They're able to buy a car at potentially lower rates. And so I think that's what's really helping out the overall market. And starting with, again, the big sort of event that happened in September was the fact that the Fed did finally cut rates again. Now, remember, we started cutting rates at the end of last year. That was the first time we cut rates. And then we went on a long pause this year, right? So from January all the way through August, the Fed was on pause, and a lot of this had to do with tariffs and whether or not we were going to see those tariffs come through into these inflation numbers, and we haven't seen it yet, right? And I think one of the things that is confusing is, people are like, well, we're going to see this come through soon. And when I think about it, whether it's inflation or the labor market, it's really about the pace at which things are changing, right? So inflation, we're seeing it sort of go up and down, but we're not seeing big moves, significant moves either to the upside or to the downside. They're relatively contained. Same with the labor market, they're relatively contained. And so that's why I think the Fed was able to finally cut rates recently. And you can see that the market had priced a lot of this in. And that's what this graphic shows, is that as of June, the market was like, well, we think we're going to see a couple of cuts by December. And you can see that they thought that by December would be at 3.7% in terms of where the interest rates are. And now, as we got closer to the actual likelihood of the Fed cutting, especially after Powell talked about the pivot towards the labor market at Jackson Hole in August, we're seeing more cuts priced in, and you can see that in the bar graph to the right-hand side. If you go to the next slide, I think one of the other things that we like to talk about is, usually the Fed is cutting rates when the economy is slowing and, we're worried about a recession. But the last few times we've actually seen the Fed cut rates outside of recessions. And that's actually been really positive for risk assets. And so what I mean by that is it's actually good for stocks. When you have a lower interest rate in which you're discounting those cash flows, it's actually positive for the net present value of stock prices. And so that's why we're seeing this sort of exuberance, I think, on stocks. And we'll continue to see that as long as the economy doesn't deteriorate further, and it doesn't deteriorate as quickly as we've seen in the past. I think that's why the pandemic was an issue. It's why 2008 is still seared in everybody's memories, is that the pace of this change was really, really fast. And we're not seeing that. We're actually seeing a slower pace of the slowdown. If you go to the next slide there, I think the other thing that we wanted to point out is capital spending. I think we've all heard how much these large tech companies are spending on data center build-outs and overall CapEx spending for data centers. That continues, and you can see the difference between the AI CapEx, the darker blue bars, versus the non-AI CapEx, which remains pretty healthy though. So I think it's not all about AI, it's actually outside of AI as well. And capital spending is one of the biggest multipliers from an economic growth perspective. And so seeing this continue to build higher is actually positive for the overall economy. And with that, I'll take it back to you.
Thanks. So just to wrap things up, we covered a lot in these last few minutes. And so just to highlight the big takeaways here, we believe that markets are really in a good place overall. It doesn't mean that we can't or won't have a market pullback. We know no one can time that. And in some sense, you could say we're overdue, but that doesn't really mean anything for a pullback, I should say. But that doesn't really mean anything because no one knows when or if that'll happen. The important thing to note is that long-term investors will be rewarded for staying in the market despite all these concerns: sticky inflation, declining labor market, concerns about name it, geopolitics, anything. The market is going to price those things in. And so the things that we care most about are how corporations are doing, and overall corporate earnings continue to be relatively solid. And as I mentioned earlier, consumers continue to spend. And so when we look at the data in aggregate, it does leave us a little more optimistic that this can continue. Yes, we're probably later in this cycle than somewhere in those later stages, especially given the fact that the Fed is cutting rates right now. But as I have pointed out, that's not necessarily a bad thing, because overall the economy is growing and we don't necessarily see a recession looming at this moment. We're of course going to stay on top of those indicators that signal that we could be heading for more of a downturn. But at this right now, we do believe the markets can continue to climb this wall of worries. So what does that mean for investors? It means, we continue to like the markets. We continue to believe that, there's value in owning equities, whether it's US equities, international equities. I think the takeaway is really to focus on having a diversified approach. We talked earlier about, the strength in emerging markets, the strength in developed markets earlier this year. Having exposure across a broad set of assets really is beneficial because of that concentration that we talked about in US large cap, mega cap growth. Yes, there's CapEx there. Yes, there's a lot of AI tailwind, and that should definitely benefit investors for the foreseeable future. But it does make investors more susceptible to volatility and sudden term pullbacks. And so we want all of our investors to just be very mindful of that. Participate, but don't necessarily be over concentrated, because just by owning the index, you're getting a lot of concentration. You don't even have to try. A passive investor, by owning the S&P 500, you're mostly buying 40% of that is the top 10 stocks. So just be aware of that. From a fixed income standpoint, bonds are continue to give you a more attractive return. We know we're pricing in future rate cuts. For those investors that are looking for tax-free income, we do continue to like municipal bonds. The spreads are a little tighter than they were a few months ago, but it's still an attractive place if you're looking for tax-free income. And as always, we always encourage investors to think outside traditional asset classes if you're looking for diversification options. That includes a variety of different investments. Please talk to your financial advisor if you're interested in ways that you can add to your portfolio of fine asset classes that are non-correlated to stocks and bonds and offer more diversification or benefits that are less correlated with things like interest rates and inflation. With that, we hope you found this month's update helpful. We appreciate you spending some time with us today. Hope you all have a great day and a great week, and we'll talk to you soon. Take care.
Thank you.